This is by far the most critically important Tesla stock video that you are going to see on YouTube for a very long time. This video could make you serious money. And we're going to talk about exactly why Tesla stock is going to go higher over the next coming months. Now, this does have a caveat. If we go into a recession, or if inflation ramps up again, and the Fed needs to give us more rate hikes than the markets are currently pricing in, well, the outcome's going to be a little bit different than what we talk about here in this video. But I will tell you, it's encouraging. The data that we got last week, well, inflation is falling faster than expectations. GDP was around 2%. We are far from a recession. We're far from the inflation issues that we've seen in 2021 and 2022. So this is the most likely outcome for Tesla stock. And it's really quite simple. So I think that's why you need to hear it. And trust me when I tell you, I did not ace math in high school. Okay, that was my least favorite subject. Did not do well in it. This is very easy to understand information. The PEG ratio is the price to earnings ratio divided by the earnings growth rate. Now, if you don't consider the growth rate, then how do you even value a growth stock to begin with? It's almost impossible. And that's kind of the disparity that's been happening in 2022. Because at face value, if you take Tesla, for an example, the close of trading on Friday, Tesla's PE ratio was 75.48. If you look at Apple's PE ratio as of the close on Friday, it was 33.25. So Tesla has a PE ratio that is almost twice as high as Apple. But which one is cheaper? Short answer is it's Tesla. The way that you would start comparing the two is you could go to the Wall Street Journal. That's who I like to use for analyst estimates for next year's EPS numbers. Apple is currently expecting full year 2023 EPS of $5.99. Next year in 2024, they're expecting $6.62. So if you go ahead and divide $5.99 by $6.62, that comes out to 10% EPS growth for the next year, essentially, right? 1 year out from today, 10% EPS growth. Now, odds are Apple's probably not going to be able to do better than that. So you always want to account for variable change. Like, what are the odds that Apple grows 25% for their EPS instead of 10%? Odds are Apple could actually grow less than 10%. Probably a better odds that that actually happens. But we're not going to factor variable change into this equation. Well, now if you look at the PEG ratio and you go ahead and divide price to earnings, which is, again, let's just refresh our memory here, 33.25, and divide that by 10. You're at a PEG ratio of 3.325. Okay, not terrible, but it's not great if you're a growth investor as well. Not at all. So let's go ahead and pull up a different tab on the calculator, and let's do that same equation for Tesla. And I already did the math for Tesla's. Full year 2023, markets are expecting $3.41 for EPS. Full year 2024 markets are expecting $4.79. These estimates have actually went down. 3 months ago, analysts were expecting $4.90 of EPS. Today, it's 11 cents lower. So accounting for variable change as well, Tesla has a lot higher probability than I would say Apple does in growing their EPS more than analyst estimates. Tesla's beat analyst estimates for every quarter that I can literally even remember. So keep that in mind. But this is analysts expecting 29% EPS growth for Tesla for next year. So Tesla's current PE ratio is, let's go ahead and pull up the calculator again, 75.48. Divide that by 29. You have a PEG ratio of 2.60. 0. Tesla is the cheaper stock by about 30%. Now, again, if you want to do these numbers accounting for variable change and say the EPS estimate is way off, which I think Tesla's EPS is really going to come in around 550 for next year, well, that means the PEG ratio is closer to about 1.5, and I think that's a little bit more realistic. I think even Apple could maybe grow their EPS by 8%. That's a little bit more logical. The 5-year kind of forecast for Apple is to grow their EPS by 6.8% annualized over the next 5 years. So 10% could be a little rich for Apple. On the other hand, Tesla's 2022 annual EPS was $3.62, an increase of 122% from 2021, and Tesla's 2021 annual EPS was $1.63, a 676% increase from 2020. What happened in 2020 that is similar to what is about to happen in the next couple of months? The introduction of a new vehicle. Yeah, the Model Y was introduced May 13th, 2020, during the pandemic crash of the stock market. Deliveries grew 80% year over year. So it had a huge benefit to Tesla's EPS, to their bottom line. You're about to see the Cybertruck come online within the next couple of months, and that's likely to have the same effect to Tesla's bottom line. But if you really wanted this broken down in simplest terms, if none of that math made any sense to you, bottom line is Tesla is a cheaper stock to buy right now than an Apple. This is based off of analyst expectations. Analysts don't expect good things for Tesla next year compared to what we have seen in the past. Bottom line is, last time Tesla introduced a new vehicle, a new model, well, deliveries jumped 80%. I don't care if you want to be way more conservative than that. Say they jump 40%. Well, that's still better than what analysts currently expect for Tesla next year. So if you account for that variable change, the chance that the estimates are wrong, well, there's a greater chance that the estimates are wrong, and Tesla actually does much better than analyst estimates, and that these numbers we're seeing could be off as well, and they could look a lot better 12 months from now. That's accounting for variable change. And that is really a topic we could make an entire video on if that's something you guys would want to hear. But the simplest way to really put it is markets have not wanted to pay for growth within the last 18 months or so now. That's because interest rates were going higher and we had an inflation problem. Interest rates make the cost of capital more expensive. It increases the odds of a recession. It increases the odds of a company going bankrupt. But inflation also makes future earnings, in which you're investing in growth stocks for, less valuable. Those are all reasons why heavily growing stocks did not do well over the last 18 months or so. Well, now inflation's no longer the problem it once was. The economy is holding up very well. You're not seeing a spike in bankruptcies the way in which we could be seeing. This is the highest period of corporate bankruptcies we've seen since 2008, but that's because bankruptcies have been ultra low the last 10, 15 years or now. Sure, they're going up a little bit, but nothing to be concerned with as of yet. Economy's doing well. Again, no more rate hikes. This narrative of fearing growth is about to come to an end, and Tesla stock will be rewarded heavily for it, especially if earnings come in better than expectations, in which in reality, that's the most likely outcome. Tesla beats on earnings basically every time they report earnings. I can't remember the last time Tesla missed its EPS earnings estimates. Well, that could mean the stock could rally even more aggressively than expectations. The bigger the beat, the bigger the rally is what we can start to expect really into 2024, I think the narrative will change from even what it was in the beginning of 2023 and even what it is today. I think your higher growth stocks, especially your quality growth stocks, like a Tesla specifically, I mean, Tesla fits the perfect build of what you would want to be invested in a lower interest rate, lower inflation rate environment. Well, this could mean Tesla is extremely undervalued right now, and these prices could be bargain bin. But really, in the short term, earnings this upcoming week will be very important, as well as the economic data coming out. Anything that signals, well, the economy is doing well, or maybe the economy is slowing down, is going to have a broader market effect, and that would also affect Tesla. What we've seen recently is things have been great. Note the 4.5% rally Tesla seen on Friday. That could just be the start of another bigger move higher. As far as the earnings calendar for this week, there's a lot of companies that you might be invested in as well. SoFi is a big one, Monday pre-markets, and Uber Tuesday pre-markets. But some of the ones that will move the broader markets, AMD Tuesday in after hours, as well as Starbucks in after hours. Wednesday after hours, PayPal, Shopify, Qualcomm. Thursday is your big day. Thursday and after hours, you're going to get Amazon and Apple. Apple, for just overall context here, Apple's market cap of over 3 trillion is larger than the entire Russell 2000. So if Apple moves big, which it typically does not, but if it did, if things were really good or really bad, well, that's going to have a huge outlying effect on the markets. And that could be the thing that sends this market higher, really that next leg higher, or even create some fear out there. Same thing with Amazon, although it's not as large. Amazon is directly related to the consumer and freight. If Amazon has bad earnings in their core business, that's not going to be a good sign for the economy and where the economy is going. Keep in mind, markets are forward looking. So if earnings are bad, people are going to say, well, things are bad today. They're not horrible, but where are they going to be 3 or 6 months from now? Bad earnings, not what you want to see this week. And then you have Fubo Friday in pre-market. This is a trade that I spent $150 on personally that could yield $7,000 if Fubo closes above $5.50 by August 11th. If you guys want access to all of my trades in real time, link down below in the description of this video. As far as the economic data, good news is we don't have anything on Monday that will move our markets specifically. After last week, that 7-year bond auction came in really bad, and it caused interest rates to jump, right? Bond yields to jump, and that's why you had that big sell-off last week. I believe that was on Thursday. So you want to watch the bond auctions from now until the end of this year. The Treasury is still raising, in the process of raising about $1 trillion within the next couple of months. So you're going to see some pretty big bond auctions. If people don't show up to those auctions, well, that's going to make your bond yields go higher. That makes the cost of capital more expensive. So those can be big catalysts for our markets. On Tuesday, you're going to get your first round of important, very important economic data, and it's going to be JOLTS job openings for June. You want to see job openings come down. The lower job openings go, the better. Best way to think about this is the Fed needs to see the labor market not be as tight as it is today. 2 ways that happens. Either people lose their jobs, which is negative for the stock market, negative for the economy, or job openings fall. Meaning that if a business was looking to hire 5 people, well, now they only want to hire 2 people. You lost 3 job openings. Nobody lost their job, but that employer is just no longer hiring 3 extra people. So that's going to be big. You're expecting 9.62 million job openings. Last month's rating was 9.8 million job openings. Best case scenario, this comes in at 9 million. My expectation around 9.5 million. That's good. As long as you don't see this go over 10 million again, that's probably good, and you're probably, clear sailing for the markets. Wednesday, you don't have anything as far as economic data. On Thursday, ISM Services PMI. This has actually been falling pretty consistently recently, so this would be good. Services, you want to see service inflation continue to fall. That's the last sticky part of inflation. If services PMI falls, that's going to be a great thing. We're expecting 53. Last month's reading was 53.9. Now on Friday, you're expecting the unemployment rate to come in at 8:30 in the morning at 3.6%. Last month's reading was also 3.6%. So you want to see this one stay pretty much where it is today. You don't want to see this go higher, right? We've seen this move higher from the lower end points that we've seen around 3.2, 3.3%. It's at 3.6%. It's not terrible. It's really good historically speaking. And the markets feel good about this. But if you start to go over 4% unemployment, we're going to have a problem, and that historically means we're going into a recession. This data comes in Friday, 8:30 in the morning, as well as that at 8:30 in the morning on Friday. The non-farm payrolls come out. You're expecting 200,000 net job ads. This would be the lowest number that we have seen in quite a long time. Last month's reading was 209,000. You've added so many jobs that non-farm payrolls, it's not going to go up forever, right? You're not going to continuously see hundreds of thousands of job ads every single month. So this one, the markets might pay attention to. If it comes in line with expectations, that's great. If you add more jobs than expectations, that's great as well. It shows we have a good economy, and that really, recession narrative, it gets thrown out the window even more. If this were to come in at like 50,000 job ads and the markets were just utterly wrong about their estimates, that's where the markets might say, whoa, what just happened, right? Especially if they were somehow negative as well. That would probably cause a 3 or 4% down move in the markets, right? In a single day. So it can be a big catalyst. It's usually not the biggest catalyst because it typically comes in better than expectations. So that's really what you guys need to know for this week. Anything else that is unscheduled that happens specifically with Tesla or the broader markets, I will bring that to your attention. Hit the like button and subscribe to the channel if you have not done so already. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.